Thank you for joining us at XM.com. In this preview video, we'll be looking at U.S. retail sales out on Tuesday and the outlook for the U.S. dollar. I'm Cristina Marujos. With me today is our lead investment analyst, Rafi Boyajian. Rafi, last week's hotter than expected CPI data boosted the dollar, but dovish remarks by Fed officials quite dented expectations of another rate hike this year. So now the attention will turn to retail sales out this week. Will the report support a pause in November?
Well, Christina, that you made some interesting points there, and you are right. We are seeing rate hike expectations being pared back a little bit. So the retail sales data will be important because, of course, we don't have that much data left in until the next meeting on October 31st, November the 1st. Of course, we're going to have the US GDP and PC inflation numbers coming up, but nevertheless, the retail sales will be important too. So we are expecting a figure of 0.3% month-on-month growth. That would be a slowdown to the 0.6% we got last time. But overall, it appears that the US economy is still in pretty good shape. We had some pretty solid payrolls numbers. We had pretty solid CPI prints as well. So what we know is that the Fed is clearly keeping the rate hike option on the table, but we do have some signs of cracks appearing in the US economy. For example, some indications that perhaps some consumers and some businesses are struggling in terms of debt repayments. We are seeing, of course, we have the ongoing threat of a government shutdown. We've got ongoing strikes. So potentially there are risks to growth in the fourth quarter. And also the fact that we still haven't really felt all the effects of the past tightening from the Fed. Despite all that, the overall picture is that the economic momentum is still there in terms of the US economy, and that's why the Fed is so far maintaining its tightening bias. Now, you could argue that why would the Fed, be on guard still, given the fact that core inflation is coming down, and the effects of the recent spike in oil prices, they're likely to be temporary. But of course, this latest conflict in the Middle East just kind of goes to show that there's still some upside risk to inflation, because we could see potentially a further spike in oil prices, and of course, the longer the higher that oil prices go and the longer they stay high, that increases the chances of second round effects, like we saw the last time we had that energy price shock. So the inflation threat hasn't gone away, and it's likely the Fed will remove the optional rate hike at its November meeting. And should we get stronger than expected retail sales numbers, that would certainly bolster the case for one more rate hike from the Fed.
And taking all of this into account, Rafi, how could we see the dollar perform this week?
Well, we saw the dollar recently rally together with bond yields. We saw a bit of a pullback, but then a bit of a rebound. So the question is, where does the dollar go from here? Now, rate hike. The bar for a rate hike has actually gone up significantly since the last meeting because of the rally in treasury yields. As you mentioned earlier, the Fed officials have been out in droves, all pretty much saying that because of the recent jump in treasury yields, that's led to a tightening of financial conditions in the market. So that's lessened the need for the Fed to do more work on its part, and that's those comments have put a cap on the rally in treasury yields. Now we're going to hear from Powell himself, because we haven't yet heard from Chair Powell. He's going to be speaking on Thursday at the Economic Club of New York, so that's going to be important. As for the data before that, should we get worse than expected retail sales numbers, that would, I think, weaken the case for additional rate hikes on the back of the rally in bond yields. The question is, would stronger retail sales numbers boost the odds for rate hike, given that the Fed is now saying there's already been significant tightening in financial conditions? Well, I think either way, the Fed is not going to remove the rate hike option from the table. But with the Fed, would stronger than expected numbers be enough for the Fed to explicitly, flag a rate hike in December or even January? That remains to be seen. One thing to note is that although the Fed is saying, okay, we might not have to do more, but that stance is actually conditional on yields remaining high. So if markets are convinced that the Fed isn't going to hike again and we see yields fall back again, then that increases the chance that the Fed will hike rates, will have to hike rates again.
Rafi, thanks so much. And thank you for watching this preview video here at xm.com.